On to candlesticks now. So candlesticks represents movement across the different time frames. They show us where the price opened, the highest point, the lowest point, and where the price closed. Candlesticks are used to read price action, and they are used as extra confirmation to take a trade. So here we have bullish movement represented by the green candle, and bearish movement represented by the red candle. So bullish is moving up, so all the upward moves would be represented by the green candle, and all the moves heading down would be represented by the red candle. So here we have a diagram showing the different points for each candle. So for bullish candles, we have the lowest point here, which is the bottom of the wick. So this is the candle, and just like real candles would have a wick, but they have wicks at the bottom and top. So for the bullish candle, this is the lowest point in the candle. This is the point where the candle opens, the point where the candle closes, and the high. So that's generally a movement like the candle will open here, move down here to this lowest point, go back up, leave a wick, then start moving up, go till here to the highest point, and then close like that. So all of the movement that this candle did is represented right here in the candle with the high, low, close, and open. For the bear candle, it's generally the same thing except for the open and close. This is the lowest point, this is the close, this is the open, and this is the high. And that's a movement like it opens here, so we're heading down now. It opens here, goes up to the highest point that it'll go, then goes back there, leaving a wick, passes that point, goes straight down to its lowest point, then goes back up to close there. So the difference is between where they open and close. For a bullish candle, it'll open a little bit lower, come down, then go up and close higher than where it opened. And for a bearish candle, it'll close lower than where it opened. So it'll open at the top here, go a little bit up, it'll go all the way down and close lower than where it opened. Here we have the different types of chart patterns. In technical analysis, we use chart patterns to help analyze and determine market direction. Here we have a double top pattern located like so, where the price breaks, gives us a bottom, touches the resistance that it broke through, gives us another low, and then right there at the resistance we have a double top pattern. And after double top patterns, you generally see sells. So identifying these patterns will definitely be an advantage when it comes to trading, because if you can identify a pattern when it's now in the stages of completing, then you can have a good entry to execute the trade. So here we have a head and shoulders pattern. You can see here a shoulder, the price generally moving up, touching the support, giving you a higher high, giving you back a low at the same level of the last, then a lower high, generally at the same level as the first high that you had. So after a head and shoulders pattern, there's also a sell, generally a sell movement happening after it completes. For double tops, it's basically the opposite of a double bottom, where the price moves up past resistance, gives you a high, a low, or a higher low from where it came from, gives you another high that is the same level as the first one, and then comes back. After this, we can generally expect a sell movement for the price. So for double bottom patterns, we look for buying opportunities on the second bounce. So once we see a bounce off of a support or any area generally with a low, a high, and a low of the general the same position, then we look for buying opportunities. So once it passes this high, we buy. So quick recap on how to trade. We first identify the pair we're going to trade. Then analyze the pair on a larger time frame, such as 1 hour or 4 hour, to know the overall direction of the market. We mark up the nearest support and resistance zones, trends using trend lines and channels. We analyze candlestick formations and chart patterns to determine market direction. And then we apply proper risk management by adjusting the lot size and stop loss to risk no more than 2% per trade. And that's it. So as long as you have this checklist covered, then it's time to open a trade. Alright, so let's discuss a little bit on reversals and continuations. So we understand that when price approaches a support or resistance zone but fails to break past it, it's known as a reversal. We know that the resistance zone refers to any area above the price where the price was rejected or failed to go beyond, and support zone refers to any area below the current price where the price was rejected or failed to go beyond. So for a resistance zone reversal, it's generally the same idea. Every time the price approaches a resistance zone, we sell, because that's the main idea. Price more than likely, more often than not, will reverse when it approaches a resistance zone. And for support zone, it will more often than not reverse when price approaches the support zone. Now on to breakout. So when price approaches a support or resistance zone but break past it, it's known as a breakout. In such case, the resistance zone becomes the new support for a bullish breakout, and the support zone becomes the new resistance for a bearish breakout. We can see that represented here by the diagram. The price approached this area right here, which is our resistance because the price is below it. So this area that is above the price is our resistance. So the price approached it, got rejected, approached but broke past it, and now that same area that was our resistance is now acting as our new support. Don't have to draw up a new line, you don't have to rename anything, you don't have to change anything. Mentally, we just understand that this area used to keep down the price, and since it was so good at keeping down the price, it's always going to be a zone where the price reacts or respects, then it would be good at keeping up the price as well. So that's why the resistance zone became the new support for a bullish breakout. So resistance turned support. And over here, we have the price approaching a support zone, being rejected, approach, rejected, then break out. This is the bearish breakout, downward movement, and that same area that was our support is now going to act as our resistance in keeping down the price. So it held up the price as the support, and now it's going to hold down the price as the resistance. Sometimes the resistance is called the ceiling because it keeps things, from going out, and the support is considered the floor because it keeps things, from falling through, if you want to look at it that way. So in a nutshell, at resistance zones we look for selling opportunities, and at support zones we look for buying opportunities. In the case of a breakout at either support or resistance zone, we monitor price movement and wait for a retest after the break. How to spot reversals at support or resistance zones. So basically three things. Strong price rejection. Strong price rejection would mean like on the charts where you can see one area standing up as a very strong area of support or resistance. When price approaches there, you wouldn't see a build-up of a lot of candles. You may just see one large candle or a wick, and that basically confirms that you're at a reversal point, or the price will reverse from there. Candlestick pattern formations, large candles with short bodies and long wicks. Like I was explaining, the candles itself would be able to give you more confirmation that, hey, this is a reversal that's going to take place, especially if the candle is approaching a support or resistance zone. So if you have a candle with a small body and a long wick approaching a trend line or support or resistance zone, then it will more than likely be sign of reversal. And power move into market structure. This is basically saying that as long as you see you're there by the charts and the price is approaching your support or resistance line or zone, and you see just a major move within the direction, then it'll more than likely be a reversal. If on the other hand it's slow and it's build up, like you're seeing a lot of candles around your support or resistance zone, then it's more than likely that the price is gaining strength to break past the zone. How to spot breakouts at support or resistance zone. Consolidation near support or resistance zone. Like I was saying, if the price approaches your support or resistance zone or your trend line and is immediately rejected, then that is sign of a reversal. However, if the price is approaching your support or resistance zone, but instead of having one large candle or one big power move at in the direction of your support or resistance zone, then it having like smaller candles and a build up of candles, consolidation, it has no like general sense of direction. It's not either going forward or coming backward. So this is an indicator of a breakout. The market is trying to gain strength to move past the support or resistance zone. Another indicator would be lower lows leading into support zone. This is saying like a downward trend line where you can connect lower highs. Lower lows would be the bottom of those lower highs. So seeing lower highs leading into a support zone, a bottom floor leading into that, would mean that there is a general sense of a breakout in the market, or the market is preparing to break out past that support zone. And in the opposite, for higher highs leading into a resistance zone, you have higher points on the market, like I'll illustrate on the charts in a minute, where it is approaching a ceiling, but instead of having power moves, you have general slow build up that is getting higher and higher as you can see it moving. So let's head over to the charts where I can show you examples of reversals and breakouts on the chart. So here we have an example of a reversal. Every time the price approached this zone here, a resistance zone, the candles would be large, but you would generally have a lot of wicks at that area, and then price would fall back down. Here is another example. Two candles, large but also with large wicks, and here once again you have two candles. This is actually a type of candle formation here with the reversal pattern. So you have the two candles equal size, and there's the wick of equal size, indicating that there's a reversal in process. And Inversely, on the bottom, you'll notice that if you paid attention to the bottom of the chart, not only the lower highs but the lower lows indicate that this, if we could just connect the tops as much as possible, and just see if we can connect this somehow. Yeah, we can just connect it like that. Alright, we can see here that it was indicating as well for a breakout beyond both this support zone right here, this support zone right there, as well as this downward channel. So by identifying the lower lows, we were able to see, all right, this kind of looks like it's preparing for a breakout, and we would have been able to spot this move, this breakout here. And by identifying the large candles when it approached the support zone, we would have been able to say, all right, this is a reversal, and since it's at a resistance, then we're looking for sells. So yes.